Hey guys, Sean here. There's a reason why high oil prices can trigger a recession. Prices at the gas pump go up, food costs more, plus it's more costly to manufacture and ship products. Now this causes inflation to soar, and when central banks hike rates too far, the economy grinds to a halt. But what happens to the price of oil during a recession, especially the one that we are already in? Now we have JP Morgan saying that oil prices could reach an insane $380 per barrel, while Citibank is predicting a fall to $65 during this recession. Now this is the most bipolar forecast banks have ever made, and we're going to dive deeper into this topic because oil prices really control everything in today's economy. Because if oil prices soar above $150, $200 a barrel, we can see stocks just get nuked and created to hell. But if oil prices come down, we can see inflation slowly calm down and the seeds for a new bull market could be planted. Now obviously no one can predict the price of oil. You and I can't, the big banks probably are clueless as well, and investment conditions can always change. Just remember that Citibank once predicted Bitcoin could pass 300 grand by end 2021. And if you're holding oil stocks or you're looking to mirror Buffett's purchase of Occidental, you need to understand the supply and demand dynamics, especially in today's freak show of a market. Remember guys, there's nothing normal about this recession that we're having. It's a stagflation, inflation sky high thanks to high energy prices, while asset prices are all collapsing around us because the Fed is hiking rates and draining away money from the system. And all this is happening amidst the backdrop of the Russia-Ukraine war. There is a case for lower oil price down the road, but there are two catastrophic events that are building that could keep oil prices elevated or send it to the stratosphere. We're talking about gas prices at $9 or $10 easily across the United States. Now, if we analyze the arguments from Citibank's $65 oil target by end of the year and even $45 by end 2023, there is some merit to them. Now, this recession is caused primarily by the Fed taking away the punch bowl of cheap credit by hiking rates, and in turn, this is crushing demand across the entire economy. Now, the problem with high oil prices is that it kind of cures itself. A higher oil price doesn't just impact our cost of living, it makes the cost of production higher for businesses and causes their margins to contract. Now, you couple that with higher borrowing costs and an environment where people are starting to spend less, we are seeing the economy contract. Now, higher oil price just doesn't allow the economy to grow, and everything about today's economy is about growth. If we take a look at the previous recessions, almost all of them coincided with the oil price spiking that triggered an economic slowdown, except for 2020, which was a black swan event. But subsequently, the price of oil started to go down because demand is just getting crushed. But on the other hand, it was the crashing price of oil that allowed the economy to gradually recover and build back up. So the Cato Institute mentioned that 9 out of 10 previous post-war recessions began shortly after a big spike in the price of oil, and yet those recessions always slash oil prices dramatically. They correctly pointed out in June 2008 that oil prices were going to crash because the economy just couldn't handle high energy prices, and they were right. Oil crashed from $140 down to almost $40. However, that is just painting in broad strokes, and today things are a little different. We are in a volatile situation with crazy geopolitical risks that could see oil prices stay elevated even though we are in a slowdown. Now, if we look back at history, we can see that back in the stagflation of early 1980s, the inflation adjusted price of oil fell from $140 down to $87 by the end of the recession. Now that's a 37% drop from its peak, and remember, this is the inflation adjusted price of oil, not the nominal price, and I find this to be a more accurate representation of oil prices. And at $105 oil today, a 37% drop will actually take us down to Citi's price forecast of around $65. Now this is very interesting because there is a bear case to be made about oil prices coming down gradually, but not a horrific 70% crash like back in 2008 or 2020. So let's quickly take a look at the demand side of the equation. And the first thing to note is the GDP decline that we are facing right now and how it compares to the past recessions. I need to be Captain Obvious here, but the further GDP falls, the worse the economy will be, and that means a greater fall in the demand for oil. And if we take a look at previous recessions, we can see that the 1980s double dip recession, which came in two parts, had an average GDP decline of 2.5%, while the 2008 recession saw GDP crash by 4.3%. And if we take a look at the Fed's own predictive data, we can see Q2's GDP had a decline of 1.2% from their GDP Now model, and their DGSE model, which is a more complex version, is forecasting the recession to last till the end of 2023 with a GDP decline of minus 0.5%. And this shows that the Fed isn't predicting the recession to be a severe one, but I personally think that that's understating things. The economy is so over leveraged that this really won't be an ordinary market crash. But if we do use this, then it means that oil prices won't really crash like back in 08. But that's just the United States. If we look at demand globally, it's still strong. And understand that this is not like back in 2020. The world has recovered somewhat from the crisis. And once China's lockdown ends, they'll start ramping up their economy once again. And we can expect demand levels to stay strong. In fact, the IEA states that oil demand is going to rise by 2% to a new high in 2023, and it would be fueled by China and non-OECD countries like Brazil, India, and Argentina. And this makes sense. People are starting to travel like bats out of hell after the lockdowns, even though energy prices are still sky high and international trade is still going on. Now, this is just a high-level look. If I go sector by sector or country by country, this video will last for hours. But we also need to look closer at unemployment numbers, because if people start to lose their jobs, there's no need to travel, people can just chill at home, and the demand for oil and transportation will start to crater as well. Right now, we are looking at all-time lows of unemployment of 3.6%, but remember, this is a lagging indicator. By the time this rises, it is too late and we are already deep in a recession. Now, every recession starts from low unemployment and spikes up once companies start laying off workers. We can see that unemployment in 08 hit 9.5% and the 1980s saw an average unemployment of 9.3%. So how far oil prices will fall, at least to the demand side, will be how many people losing their jobs. And before we think that it can't get any worse than 2020, remember that unemployment during the Great Depression hit an astounding 25%. So we know demand will come down as the economy contracts, but it likely won't be cratering to earth unless this recession really deepens. But what about the supply side of the equation? Now, this is where we get into a horror story, a tale of self-inflicted wounds, and a terrible war in Europe. You already know the terrible conflict in Ukraine is causing huge supply disruptions in both oil and gas prices. Firstly, we have the embargo on Russian oil. According to the World Economic Forum, Russia is the world's third largest oil producer, but it is the largest oil exporter to the global markets. And when you decide to sanction Russian oil, you are cutting away a huge chunk of the world supply from your country. And according to the IEA, just in the OECD countries alone, which includes the US, Russia supplies 5.5 million barrels per day of oil to them. And this accounts for 26% of the oil imports, which is a huge amount. And this is the case that JP Morgan is putting forward for their $380 price target in the most extreme scenario. They are saying that if Russia cuts their oil production to the west, this could send oil price soaring to outer space. And if you didn't know already, the G7 is discussing imposing a price cap on Russian oil, which is honestly the dumbest idea I've ever heard. Essentially, the West is going to form a cartel to tell the world how much they can buy Russian oil for. So if the price of oil is $100, they will set the terms that Russian oil might only be worth $50 or $60 a barrel. And it's a plan that allows oil to keep flowing while limiting the amount of revenue Russia can earn. But honestly, this idea can only work in fantasy land. Russia could always counter this price cap by just not exporting oil to the G7, right? Putin could keep Russian oil off the global markets. And according to JP Morgan, they mentioned that Putin can cut output by up to 5 million barrels a day, which is the entire supply to the OECD countries, and not hurt its own economic interests. And if Russia just cuts 3 million barrels, the global oil price can climb to $190. Now, this is the real possibility that Russia just won't play ball and the world will be left holding the bag. Now, the United States is trying to get Saudi Arabia to pump more oil, but it seems that they can't really ramp up production that fast to make up for the shortfall in Russia. They might already be at full production capacity, and you can't force any more oil through diplomacy in such a short time. So on the supply side, we are seeing a supply crunch that could possibly get worse if the West decides to go ahead and impose a price cap on Russian oil. But the most tragic part of this story is how a ton of the supply side problems could have been avoided in the first place. I've been talking about this a while back, but here are the cliff notes. Biden pledged to concentrate more on renewable and green energy at the expense of the oil industry. In fact, he vowed to get rid of fossil fuels and unleash a series of unfortunate events that just left the oil industry broken. He cancelled the Keystone XL pipeline that would have transported 800,000 barrels of oil per day from Canada to Texas and prevented new drilling from happening with an oil and gas lease moratorium. Till today, both of these aren't reversed, which is simply bewildering to me. Solar power and green energy can't replace the energy demand shortfall, not for another decade at the very least. And this is the big problem. There has been a period of underinvestment in the oil industries, drilling for more oil, installing more pipelines, and building more refineries to increase capacity. All this weren't done, and this is at the heart of the problem. And it's not just America. Europe also focused too much on renewables too early too soon, and that is why they are at the mercy of Russian energy. There have been many bizarre decisions made in Europe, and this included the Netherlands shutting down their gas fields due to earthquakes, Germany shutting down nuclear energy after the Fukushima disaster in Japan, and Europe closing their coal power plants to meet their climate change targets. Now, even if the EU leaders and Biden all scramble to invest in oil and gas tomorrow, it will take some time. US refinery capacity is at 94% and you just can't conjure up new plants from thin air. We are talking about years at the very least, but the story can get worse. This is a horror show that might have a season 2. You see, right now Biden is blaming the oil companies for not pumping enough and not refining enough, and there are discussions that a windfall tax might be slapped on the oil companies. Now, I'm not siding with big oil, but it's clear that if you remove the incentive of making money from them, they won't want to spend more to invest to pump more oil when the profits will just get eaten up, right? Strangely enough, I have a weird feeling that this might actually happen. Now, the UK has already imposed a windfall tax on their oil companies, and America might follow suit. So if you're invested in oil companies like Chevron, Exxon, you better hang tight and pray that Biden doesn't. So if you combine this with Russia deciding to cut off their oil supply to the world, we could really see oil prices fly up to $150, $180 a barrel easily, but I still don't think it will reach $380. That figure is still too far-fetched, and I really want to see the spreadsheet on how JP Morgan arrived at that figure. Now, it's really anyone's guess if oil prices will spike up in the short term to insane levels, but on the longer term, I believe oil prices will eventually calm down. Natural forces of a recession will just crush demand, and the cure for high prices is high prices. So on a base case, I tend to agree more with Citibank's $65 oil forecast. Maybe not by year end, but sometime in 2023 is definitely possible. Now, big caveat here, we are living in crazy times, and so far we have had 2 black swan events back to back, the pandemic and the Russian invasion of Ukraine, so I won't be surprised if Russia does cut away oil supply. So oil prices on the whole should come down. It will start to bring down energy inflation as well. That will mean oil and food prices will become cheaper, and for the economy as a whole, it will be good news. There will be more breathing room for companies to grow, and people have more money to save and spend around, and this can really lay the foundation for the next bull market. And that's why if we take a closer look at the chart, oil prices really tend to be very cyclical, and when oil companies start to crash and underperform during the recession, that could be the best time to buy. Just take a look at Exxon's stock price during every recession back in 2000, 08 and 2020. The price created when oil prices dropped and then shot back up to new highs after the economy started to grow and demand for energy slowly returned. So personally, if oil was to fall to $65 or lower, I'll be picking up some energy stocks then. I think we need to be prepared for both scenarios where oil prices could soar in the short term and drop as this recession deepens. We have to remember, this could be the mother of all recessions if the Fed really steps in to bring inflation all the way down to 2%. We really won't know where interest rates could rise to and how it could just crush demand. Obviously, I'm stocking up on food because that is a near guaranteed ROI if oil and fertilizer prices continue to shoot up. Honestly, when was the last time food prices really came down? I really can't seem to remember. And when it comes to oil stocks, I've exited my position since Biden sent that angry letter to the oil industry, and it's very possible that a windfall tax might hit the industry. But if it does, we can expect the oil companies to hit back and just not invest more into their future production. And this will keep oil prices supported for quite some time. So we probably won't see a dramatic drop to Citibank's $45 forecast in 2023. So if you're betting on the price of oil or on oil stocks, you will need to have holding power because a recession is really going to crush demand. And will it cause oil to fall by 70%? I really don't think so. We'll be correcting from a somewhat strong demand level while supply issues aren't really easily fixed. So let me know what you think. Will oil prices crash badly, or will JP Morgan's crazy $380 prediction come true? Let me know in the comments below. Stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe as we navigate through these challenging times. Thank you guys for watching, and I'll see you soon.